Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. Check us out at jazzwealth.com if you would, and thank you for doing that. How's it going today? Hope you're all having a great day out there. Look, the markets are a little bit wild lately, and I get this question all the time. Dustin, don't you think the markets are going to hit some sort of a top here and start pulling back? And they kind of have in the short term. But if you're over the age of 50, there's something going on in your head. You realize what 2008, 9, and 10 look like, and you go, wait a minute, I'm getting closer to retirement. I don't think I want to participate in that again if I don't have to. And so a lot of our customers that are over the age of 50 are saying, Dustin, can we afford to be less aggressive? Can I just slow things down here and maybe take less aggressive investments just in case? Is it going to hurt me? And so we're going back to our plans. For every one of our customers, I do an initial plan for them where it turns out to be a longer email, but we go through, okay, what do you have? What do you need? And what do you expect? And that's kind of what we're going to go through today. For those of you that may be over 50, I'm going to use an exact example from a customer that we used. Cole and Amy were our customers here. And really cool jobs, by the way. They happen to be the people that go and build airports, in particular the runways, and lay all those things out. So they get to travel all over the world and build these airports, the runways and the taxiways and all that stuff. It's really interesting. They work together. Somehow they make that work. I couldn't work with my wife. Love my wife, but couldn't work with her. Absolutely not. And so they came to me and said, we're a little bit nervous about the markets here, Dustin. We have a long time until we want to retire, but we just don't want to participate in any of this mess if we don't have to. So what I did is we went back to their plan and I said, okay, let's do it. What do you have? Right? That's where we always start. What do you need? And what do you expect in terms of like other income, Social Security, and things like that? So we're looking at each of these first. And I want every one of you guys to do this. It's going to take a little bit of math involved. If you decide you want to work with us, that's cool. You can go. But this is not really like a sales pitch today. This is just to kind of go over an example. This is what you're going to do. So Cole and Amy, they have $490,000 currently saved up between a couple 401ks. They're big Roth IRA people. They did some conversions a couple of years back. And so they've got a lot of post-tax money, but I'll show you how that plays into this in just a second. Now, Cole and Amy, they make really good money right now, but here's the thing. They're a little bit different. They already get to travel the world. They're going all around the world building these airports. So their vision of retirement is that when they retire, they just kind of want to hang out with family. They're going to stay here. They're not going to travel as much. They've seen more than probably most of you. I mean, they're well traveled. So they kind of want to spend time with family, grandchildren, etc. So they think they need $50,000 in total income throughout their life. Now they had a kind of a long stint where they were self-employed, so they don't expect a lot in Social Security. In fact, they've looked it up. They expect to take $17,000. They happen to be the same age, by the way, so this is good. They're going to retire at the same time, not quite full retirement age, but they're going to look to take their Social Security at 67, and they expect $17,000 a year. So that's the starting point, right? That's what they have. That's what they need, and that's what they expect. Now, the $50,000 of need, 17 of it, of course, is going to be taken off because of Social Security. They expect that. And we got a tax component in there as well, so we're going to factor that into the overall equation. Now, currently, they're both the same age. They are both 52 years old, right? So you're going to kind of take those numbers. You're going to look and see where you're at in terms of what you have, what you need, what you expect. Then look at your age, and I want to know, when do you want to retire? They've decided 67 years old. They actually have contracts and everything all the way out that long. And so assuming all of that continues, they plan to work until 67. They both love their job due to the travel and all the fun they get to have. And they're really good at it from what I hear as well. Okay, so we've got some variables here. We need a few other things. We need to have an expected inflation amount. I always use 3%. That's a little bit high right now, but I like to use 3% for that. You could change that if you like, but you want to look at inflation. This is important because a lot of the calculators that you use, they're sort of raw. They just say, okay, if you have this much money, how much will you have if you get a certain return over the next few years? And when you hit retirement, what's that going to be? We like to factor in inflation here because I like people to account for inflation along the way. What that means basically is your dollars are losing value each and every year. So I'd rather have you save more each year, and just up your contribution each year to offset that. So if we use 3%, whatever happens at the end of this result here, if let's say you had to invest $5,000 a year to hit your $50,000 a year goal, Well, you'll do 5,000 this year, but next year, if inflation is 3%, which right now it's not tracking to do that, it'll be lower. But if next year you raise your contribution by 3% and you put more money in, it'll be $5,150, then what you've done is you've offset the decline in the value of that $5,000. It's a lot tighter of a way to calculate your future retirement versus just saying, if you save all this money and we just guess that inflation is going to be something along the way, then that's it, right? You just kind of guess. And it's just not a very good way to be factoring out your retirement. If we know what inflation is each year, 1.6 last year, I believe 2.2 the year before, if we know that, then we could just raise our contribution by that amount. So we're going to factor that in at 3%. Now, what I like to do with their $490,000 and the $50,000 and the growth after the age of retirement. So they got $490 now. What I like to do is say, okay, that money plus everything that grows into the rest of your life, we're going to tax it at 25%. So we're going to assume a 25% tax rate. That is really, really high, but it's a way that I can sort of underestimate, right? What happens there is when we go calculate all of this, we're going to end up with a number that is more conservative because it's very likely they're not going to pay 25%. I guess anything's possible, but very likely at this point, wanting $50,000 a year, even after paying a portion of tax on their Social Security payments, very unlikely they're going to pay 25%. Okay, so then what we can do, now that we know this, we know what they have, we know what they need, we know what they expect, we know their age, we know when they want to retire, they're both going to retire at the same time. We're using an assumption for inflation here, and we're going to use an assumption for their tax overall. All right? Here's what we find out. With all of this, they actually don't have to invest any more, assuming that they grow at a net 7%. All right? So if we have a 7% growth rate, which is what most people use, right? Growth rate of 7%. Technically, the S&P returns about 10% on average, but if we back out the 3% for inflation, that's why most people use 7%. That's why you see that number thrown around there. So we know that as long as their investments generate 7% returns, that they technically don't need to invest any more dollars. They are still doing that, but they don't have to. Now that we've figured that out, we go, okay, 7% gets you to your goal. What if we bring it down to 6% growth rate, right? What happens then? Do you still have enough money to live off of $50,000, the future value of $50,000 in retirement without having to save any more? The answer is yes for them. In fact, when we run this number, we come all the way down to 4.68%. This is really, really important here. Now, they're customers of ours. They're paying us 0.5%. Just be honest with you. We don't hide our fees, right? There's nobody that's going to work harder for you, but our fees are right on our website there, so you can see. And in plain, honest to goodness truth, they're paying us 0.5%. So at the end of the day, after the 0.5% of our fee comes out, they've still got to grow at 4.68%. In other words, they could grow less if they did it on their own. They don't want it because they want the help that we provide and the advice and everything. So 4.68 is the total, is how I should say it there, the absolute total. Okay, what does that mean? Now that we know the number, Cole and Amy are saying, can we invest less aggressively? They feel like the stock market is a little top heavy here, right? Let's say they're right? We don't like to try to time the market. Everybody knows that. It's a little bit difficult to do that. But the stock market's had this incredible run here. They're worried about some kind of a decline. They'd like to participate less in that. They're currently investing rather aggressively. I've looked at their 401ks. Of course, I know how I'm investing here for them. So they're investing rather aggressively. If the stock market falls, currently, Cole and Amy are going to participate in all of it. So if there's a crash, a collapse, couple recessions, whatever happens, they're going to participate in all of it. Now that we know they only have to generate 4.68% return, let's round up to 5 just to make it simple. We know how we can invest for them, which means, yes, they can take less risk. We can back down. In fact, if you go to our website, you can see all of our portfolios. They're listed from most aggressive to most conservative. You just click on them and you can see all the performance and everything. You can also see the volatility. We know that they can choose our lower funds. In fact, we put together a couple portfolios to show them if we mix a few of our funds together, you can actually generate close to the 5%. It's a little bit over, really, but we're just playing it safe here. and the overall participation rate goes down significantly. So without being like super geeky here, in this case, if the markets fall, they're participating at less of a rate, right? So if the markets fall, let's say 10%, they're going to participate in about 4 to 5% of that decline. That doesn't mean they're taking no risk, of course. They will see a decline if the markets start to fall, but they know they're falling less. What does that mean overall when the markets bounce? The next time the markets start any kind of a rally, they're already ahead of the game. And I know this is oversimplifying, but they're already ahead of the game, so they can start to participate on the way back up a lot sooner. Now, they're not going to participate at the same rate. They know that. They're okay with that. But the idea here is someone came to me and said, I'm concerned about the market. Are you concerned about the market, the economy, everything where it's at? If so, and you're over the age of 50, can you afford to back down, right? If you ask me that question and you're one of our customers, we're going to revisit that first plan that we put together. We're going to go back and see what's the least return you can get and still hit your goal, right? Now, in this case, they did good. They've been good savers over their lifetime. It could very well be that you still need to invest more dollars. If that's the case, what we can do is say, okay, you need to invest X number of dollars if you're going to invest aggressively and weather the storm if there is one. If you want to invest more dollars, we can back down the investments. A lot of times people don't like to do that, but we could at least analyze that and see what's going on there. So what I want you to do is if you're asking that question, you're looking at the markets, you see the red on the screen, you get a little bit scared, ask yourself, do I have enough to where I don't need to invest so aggressively? Maybe I can just step out of the market a little bit here or slow my investments down. It's a really, really important question to ask. Anyways, I hope that helps you here today. Just thought I'd bring that to you real quick to give you an idea of how Cole and Amy are doing so you can take a look at your finances, get together with your spouse, right? See what you guys can do. Take as little risk as you have to hit whatever your particular goal is. All right, if I helped you in some way, you know the drill. Hit the subscribe button for me. I really appreciate that. And come back later. We do a live stock market update show to talk about all this madness out there, to give you an idea of how things are going, and hopefully share some geeky stats with you along the way. Thanks for watching. We'll talk to you soon.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.